Now I will introduce our esteemed speaker. David Dietze is President and Chief Investment Strategist of Point View Wealth Management, Incorporated, an SEC-registered investment advisor, which he founded in 1993. Point View Financial Wealth Management has been named one of the country's top wealth managers by Bloomberg Wealth Management magazine, as well as number 5 on CNBC's ranking of America's top 100 fee-only wealth managers. Point View assists individuals, families, trusts, and others to develop and implement appropriate investment policies in the financial management of their financial assets. David Dietze speaks and writes frequently on financial topics. He has authored articles such as To Index or Not to Index, published in Better Investing, International Investing, published in the Metropolitan Corporate Council, and Over the Long Run, Stocks Prove Worth, published in the Independent Press. He also published the article, The Limited Liability Company, Latest Strategy and Developments in Insights, the Corporate and Securities Law Advisor. Additionally, Mr. Dietze teaches courses on investing, including at the Summit Area Community School. Mr. Dietze, interviewed frequently by the financial press, has been cited in various periodicals, including the Wall Street Journal, the New York Times, LA Times, Forbes, U.S. News and World Report, Investors Business Daily, the Star Ledger, Business News, New Jersey, the Daily Record, and Strategies, Fidelity Investments Magazine of Personal Finance. He also appears regularly on Bloomberg, CNBC, Fox Business, and CN8, the Comcast network. Mr. Dietze is actively involved in local community and charitable activities. He is also a member of Summit's Board of Education, including chair of its policy committee, president of the Dartmouth Club of Suburban New Jersey, past president of the Rotary Club of Summit New Providence, past president of the Summit Tennis Club, past president of the Downtown Club, board of trustee, and chair of the Planning and Budget Committee of the Overlook Foundation, vice president of the Summit Area Public Foundation, and chair of its investment committee, and past board trustee, treasurer, chair of the investment committee of the Summit Area YMCA, co-head agent for the Dartmouth College's class of 1978, member of the Reunion and Gift Committee for the University of Chicago's Law School class of 1982, and an active member of the Suburban Chamber of Commerce and the Canoe-Brook Country Club. Mr. Dietze enjoys reading, tennis, golf, skiing, and paddle tennis in his spare time. It is with pleasure that I introduce to you Mr. Dietze.
Thank you very much, Marcella. It is indeed a pleasure to speak with this group. My wife and I, Claire, came to Summit, over 20 years ago, and it's probably the best move we ever made to work and live in this community with this fine group of people. To be part of the life here has just been outstanding. Of course, we've got 2 kids in the Summit Public Schools, a freshman, Betsy, and a junior, Billy. It's just really all been working out. Before we get started here, some particular shout-outs are in order. First, of course, to Joe Steiner, who tirelessly, not just for the Chamber, but for the Rotary and so many civic and charitable activities in this town, gives of himself, and we are lucky to have him, and I personally am lucky to have him as a friend. And ably assisted, of course, by Karen Hadley, who's stepped up into the role just beautifully and is making it possible for us to have not only the First Friday breakfast, but all the other activities that the Chamber has. So thank you, Karen, for that. So let me try and turn this thing on here. I have the pleasure to talk with you about my passion, my topic that I love to talk about, which is basically finance, the economy. and perhaps how you can make money or at least avoid losing it. So let's get right into a look back to last year. What happened last year? Basically, it was a nice year in the stock markets, double-digit returns. We'll get into some of the details. As business owners here in Summit and otherwise, we enjoyed an improving economy. As homeowners and a lot of us and real estate holders, we saw the effects of the falling interest rates. As we drive around, we've noticed also that there's a dramatic fall in energy prices. All of this is coming in an absence of inflation. Meanwhile, if you're looking at trips, look to go overseas because the U.S. dollar is soaring, allowing our currency to purchase a lot more than it did just a year ago. And of course, the other thing that we're going to talk about is a little bit on how the United States is an island of strength in a globe full of troubled economies. So let's get to how the markets did. Well, as you can see, it's just a pleasant picture. Here, we're talking about the S&P over the last 3 years, and it's just been a remarkable story. The details for 2014, up 13.7%, which is better than the long-term average on the market, so we were pretty darn lucky, and you can see that continues a stream of positive returns over the last 3 years. And indeed, the market has nearly tripled from that bear market low that we saw in March of 2009. Similar story here on the Dow. This is the Dow over the last year. Not quite as strong, up just under 10%. The laggard there was IBM, Big Blue struggling a little bit. Of course, you had two energy stocks, Exxon and Chevron, that weighed down the market averages. And General Electric seemed to get stuck in the mud, and so that weighed down the Dow versus the S&P. So, of course, those are the two key domestic equity markets. Let's take a look at bonds. Of course, a year ago, we talked about how interest rates were only going to go higher, but in point of fact, bond investors made nearly 6% on the Barclays aggregate, including interest returns. But it was a bit of a tale of two markets. Not everyone did so well. Small caps were outstanding performers in 2013, but last year trailed significantly the S&P, up just 5%. If you diversified overseas, it was not a good year. When you factor in currency changes and weak overseas economies, overseas indexes dropped 7%. And emerging markets did not emerge last year for investors, down 5%. Interestingly enough, sensitivity to duration. What do I mean by that? Those who had long-dated interest rate holdings did extremely well. ETFs that had treasury bonds that matured 20 years or greater, they were up 24%. And Vanguard had a so-called extended duration bond fund, which just had zero coupon, 30-year treasuries, up 46%. Interesting. Actively managed mutual funds underperformed. Only 13% of actively managed large cap domestic mutual funds beat the S&P 500 index. Hedge funds didn't hedge in the right direction last year, up just 2.3%, the worst relative performance since 2011. Even actively managed bond funds underperformed the indexes, up only 4.4%. So that's where the markets were. If you were in an S&P 500 index fund, you did pretty well. Let's just take a quick look at how the economy did. Economy is improving. A year ago, we had the so-called polar vortex. We had a negative GDP print, partly because of the snow. That reversed course dramatically. By the third quarter, after revisions, we had an up 5%. So things are going well in terms of GDP. And the most important number in the economy, perhaps after the gas price, is the all-important unemployment rate. And as you can see, let's see if this pointer works, down here is 2014. You can see the dramatic drop in the unemployment rate. Basically, we were at nearly 7% at the start of the year. We ended the year at 5.8%. Today is the news release for how the December jobs came out, but we're expecting that to work out well too. Auto sales surged up nearly 6% over the prior year at a rate of about 16.5 million. Real estate did well too. Sales up 7% last year versus the prior year. Prices up almost 6% versus the prior year. Let's take a look at those interest rates here. There, writ large, is your interest rate path over 2014. We started the year at 3%. People said we're going to 4 or 5. Everyone was dead wrong. We ended the year under 2%. This is just a phenomenal drop. This happened despite the termination by the Federal Reserve of their QE program, where they're buying back bonds. That ended in October. And of course, if you look here at this federal funds rate, this is the rate that the central bank in our country uses to control and spur or retard economic development. This is a very short-term rate. This shows it going back over the last 20, 30 years. And you can see at the very end here, where for the last 6 years, that federal funds rate has stayed between 0 and 1/4%. So the question is, is the economy getting better? The market seems to be doing better, but our interest rates keep falling. And one of the reasons that people speculate is that rates overseas are even lower than ours. Right now, for example, the 10-year government bond of Germany is about 1/2%. So you've got a euro that's sliding, you've got a lower interest rate. It's kind of a no-brainer for people to take their money and bring it over to the United States. I guess one of the things that we're watching very carefully is, what does it mean that people are willing to give up their money for just 2% for 10 years? What is there a fear? Is there some sort of goblin out there that we are missing that's driving that? So the other thing that really made 2014 noteworthy was that basically the price of oil dropped by half since July. And you can see that movement down. This shows oil over nearly the last 30 years, and you can see this sharp movement down, over 100 to under 50. And so, the question is, what was that due to? We're hoping that it was a supply shock, which means that with improved technology allowing for fracking and other technologically advanced ways to extract natural gas and oil in this country, there's a lot more supply. That's pushing the price down. We're hoping that because Libya got back online, that's pushing the price down. A more ominous reason is that the fall off in economies overseas is so severe that there's just a demand shortage. There's very little demand, and that's not as good. There's a lot of conspiracy theories out there that maybe the Saudis and the United States kind of conspire to put pressure on major oil exporters who we are not so friendly with. At the top of the list would be Mr. Putin's Russia. At the top of the list would also be Iran. The only thing that gives any credence to that is, although fracking has been building up momentum for the last 10 years, that price starting in the beginning of July just dropped dramatically. So if it's just increasing supplies, you would think it would be a more gradual rolling over. No one knows for sure. The other nice thing about what's going on in our economy here is that inflation is basically a no-show. And you can see that we ended the year with an inflation rate at about just 1.3%. That's good for consumers. I guess the question is, what does that signal if there's so little demand out there to push prices up? It's below the target for the central bank of about 2%. And of course, if you're a wage earner, it gives you less leverage to go in and ask for a raise. It's certainly exacerbated by a soaring U.S. dollar, which reduces the prices of imports coming in. Commodity prices extremely weak, and there's still some slackness in the labor market and the international competition. The questions that remain, of course, is will indeed the Federal Reserve raise those interest rates as they are committing to do without inflation starting to pick up a little bit? Because inflation has these two components. You've got one part just to compensate a lender for the depreciation of the value of their money, and the other part for deferring gratification. And to the extent that the portion of interest rates that are tied into inflation keeps dropping, it's hard to see how an interest rate increase is going to stick. You've got the other hallmark of 2014, which is soaring dollar. Versus the euro, as you can see on the right-hand side, the euro dropped nearly 14% last year. So as I mentioned, if you're thinking of vacationing in the islands or in the French Riviera, maybe the French Riviera is the better spot here. And it's not just the euro, but it's against a basket of currencies where the dollar rose generally about 13% versus them. And of course, the big debate is what effect does that have on our economy? If you're in a business where you're trying to export, that's not good because that means your prices are up 13% and it's tough sledding versus your overseas-based competitors. On the other hand, it helps us keep the oil prices down, helps keep inflation down. Our dollar goes further to the extent we're importing. So is king dollars generally a good thing, but is it too much of a good thing? And we'll find out. And then finally, just to summarize, overseas, a lot of problems. Both Europe and Japan are teetering on recession. You've got China, which is still growing, but at a much slower rate than we've seen. Remember, China is now the number 2 largest economy in the world. So if you got your number 2 economy slowing dramatically, that's not helpful for the United States and for the rest of the world. And of course, the question is, to what extent are we dependent on the overseas economies? You can argue it both ways. In your S&P 500 index fund, about half the revenues of those companies are coming in from overseas. That's very important. On the other hand, when you look at the overall economy here in this country, it's only about a 15% exports of goods and services. So we'll see, but it's something to watch for. So that was last year. But what's really important is what can we look forward to in 2015. And the consensus among the strategists is an up return of about 8%. We got off to kind of a rocky start. We had a good day last year. We're already up a little bit so far this year. Interest rates are supposed to rise gradually. The economy seems to continue to gather steam as real estate picks up, auto sales continue, and there's supposed to be expected gains in the number of jobs out there. And of course, the other thing we're watching is the Federal Reserve is looking to take their first steps to normalize rates. We saw on a prior slide that their federal funds rate is close to 0. They want to notch that up so that if there is another downturn or crisis, they've got a little dry powder where they can bring rates back down again to help us, as it were. So what are the challenges for this coming year? Last year, corporate profits were up about 7.5%. The outlook this year is for a slower rate of growth in terms of corporate profits, only about 5%. And some of the things the naysayers are looking at, well, look, a lot of those corporate profits were because you held back on capital expenditures. You cut your labor force. You bought back a lot of your stock. Those are great short-term boosts to profitability, but are they sustainable over the long haul? What people really want to see is revenues, some pickup in terms of what's going on at the cash register, and we're not seeing that. So that's something we're watching very closely in terms of the outlook for corporations. Of course, higher rates. If you're a saver, if you're a retiree, higher rates could be good. But if you're looking to buy a house, to expand your business, that's not helpful. So what's going to happen there? Of course, we've talked a little bit about the stronger U.S. dollar, has its positives and negatives. Overseas economies, are they going to get worse? Are they going to get better? All eyes are on Mario Draghi, who's got the same job as Janet Yellen has over in Europe, and what he's going to do later on this month in terms of perhaps launching a European QE or buyback of bonds to spur economies. And of course, geopolitical fallout, weak oil. You've got countries like Venezuela, Russia, in the Middle East, Argentina, a lot of countries, which are very dependent on oil and the revenues it brings in. And to the extent that those revenues drop off dramatically and government programs are cut back, what does that spell for peace in the world? May not be a positive. So, how to make money in 2015. We've got the big picture, but then it's always like, well, how am I going to make money? This is interesting. But, basically, as Claire, my partner in crime over at Point View, says, a lot of what people need to do in order to boost their nest egg, we all know what to do. It's like getting in shape. It's like dieting. There's no magic. And it's just a question of doing it. But, you start by saving. We try and work with people in terms of improving the return on their nest egg, but if you don't save, you're not going to have a nest egg, so you got to save. We really want people to leverage their retirement accounts. We can talk till the cows come home about the tax advantages, which type of account is best, but the beauty of these retirement accounts is they're like the virtual piggy bank. You've got some money, you fill your 401k, 403b, IRA. Once it's in there, you're very reticent to take it out, and that means it's going to stay there. It's a great defense against your greatest spending plan. And of course, we urge people to tilt to equities. We have talked about how low those interest rates are. At 2% 10-year treasuries, not going to get most people where they want to go. In terms of you all as chamber members, as business owners, entrepreneurs, etc., take advantage of the low interest rates now. I was just reading this morning that the 30-year treasury is at about 2.6, and the all-time low is about 2.4. So if you're thinking about refinancing, do it. Be nice to your employees. They're going to have more options as the wages pick up. And take advantage of refinancing your home. Brace for the weakness overseas and consider that international holiday. We talked about maxing out on the tax sheltered retirement plan. This year you can do up to $18,000 to 401k. If you're like some of us here, over 50, you can add another $6,000. Do that IRA, $5,500 plus another $1,000 if you're over 50. 529s, overlooked opportunity. Remember, this can be used for kids' education. You can put in as a gift $14,000 a year or more with your spouse 28. The beauty is it grows tax-free, it's taken out tax-free, unlike the regular retirement accounts. And of course, if you got debt, pay it down. Start with the credit cards, the non-deductible debt. In terms of equities, we're telling people invest half to 80% of your money in equities. This is your long-term money, and then the other portion in fixed income. Don't go less than half in equities. Don't go more than 80% in equities. In terms of those model portfolios, particularly for the tax shelter accounts, go for the index funds. We think it makes sense to split that equity money basically three ways. S&P 500 index, but also take advantage of the weaker year for small caps, which tend to grow a little bit faster over the long haul. Put a third there, and take advantage of the weakness overseas. Yeah, the outlook is a little more muted, but the prices are down, buy low, sell high. Put a third into an international index fund, and then use a total bond market index fund for your fixed income, and then go back to what the plan was and rebalance as the prices move around a little bit. For the taxable accounts, we're actually big believers in keeping your equity portion of your nest egg in the taxable account because the equities qualify for the reduced capital gains rates as opposed to ordinary income. And of course, lower rate on your dividends. We like the individual stocks, the unbundled portfolio for the taxable account, for the ultimate control and cost savings of matching gains and losses. We like, in terms of stocks we're promoting, we like cheap, we like high dividend, we like stocks that dominate their markets. Just two I'm going to cite today. Take advantage of the lower energy prices. Look at like your Dow energy stocks, Dow with a 3% dividend. Remember, that's 50% more than the 10-year Treasury. When you think about that dividend, historically it's increased anywhere from 6 to 10% per year, starting at 3, increasing 6 to 10% per year, or starting at 2 and flat for the next 10 years. Chevron is close to 4%, and if you're using bonds, use tax-exempt, not taxable. Run the math, but typically you're better off with the tax-exempt. And what do we think you should be avoiding? Well, job one is don't fail to diversify. And everyone agrees with me, but when it comes to their employer stock, you watch, it mounts up quickly. And I know there's taxes and you know your company well, but watch for that. There are people who are your neighbors who had a lot in Lehman and Bear Stearns, and other folks were involved with Enron. And so you don't want that to bite you. Avoid excessive cash. CDs, you just don't have the yield at 1% or less, plus it's taxable. Annuities, the problem is they tend to be high cost and you have lower liquidity. I'm generalizing here. We like the low-cost index funds. Conversely, therefore, high-cost hedge funds are something to be wary of. Most alternatives, you can get exposure to them by commodity stocks. Junk bonds actually underperformed investment-grade bonds last year. A lot of them are energy challenged. So be cautious. Don't buy things just for the yield. Look for the total return. Real estate, we love real estate to live in. We're big on liquidity, so we're cautious on that as an investment. Anything done primarily for tax reasons can ultimately bite you. And of course, be careful when the only way you're going to be able to make a profit that's competitive with alternatives is if you leverage it up, because somehow you get stuck holding the leveraged debt when things don't work out. So this is my presentation for this morning, and I'd be happy to take some questions. And if I know I got some professionals here, fortunately I've got some a wingman, John Petrides, my new colleague, to help answer any of the questions. So who wants to start it off? Bob, you going to do an IRA this year? Yeah. Well, so as a general proposition, we would favor for the private individual short-dated tax-exempt bond fund where you're going to get some interest. Well, money markets is about 0. So if you get 1 to 2%, that's 100 to 200 times more on your money, and you're not going to pay taxes on it. That makes a lot of sense. If you're extremely wealthy, you may say, I mean, Warren Buffett doesn't worry about whether you're putting aside some money for his next car, you know. And so obviously to the extent that you can withstand volatility, stick with your overall investment plan. If you're a non-taxable investor, a foundation or something, then your bank account, your bank money market may make sense. But we do caution people, not to go over those FDIC limits. The first thing people want to look at is how long do they expect to stay in their home. So we hate seeing people who are 85 taking out a 30-year mortgage. I think the average family stays in their home for about 7 years. So to pay up for a 30-year mortgage when you're unlikely to stay in your home for 30 years, why? Why do that? I think the 7-year period then probably makes some sense. And my guess is, talking with someone such as yourself or other bankers in the room, you're going to pay lower interest. Well, the first discussion we have with people is, why is generating income so important? I mean, we kind of start with the idea you need cash flow. Most of our clients are getting distributions on the 15th of each month, anywhere from $1,000 to $14,000. And so our job is to maximize the return on the portfolio with the least amount of risk. And so with today's low commissions, $7.95 to sell, I mean, if Exxon is going to give you the best return on a risk-adjusted basis, why do something else for 4% when Exxon's going to give you the dividend of 3 and perhaps capital appreciation of another 3 and give you 6? So that's one answer. Another answer, of course, is to really be careful as to the tax situation, because people can talk about a lot of high yield bonds, but a lot of us in this room, 39.6 to Uncle Sam, plus perhaps a Medicare surcharge of another 3 to 4%. And then, of course, Mr. Christie comes into play too. Close to half the income on a 6% bond is going to be coughed up in taxes. That leaves you 3. So then I would say, look at if you can get 4% on a muni and pay no taxes, that's a better deal for income than 6% fully taxable. Then some people say, well, then I'll put it in the IRA so I don't have to pay the taxes. But then the question is, unless you're 70 and a half or older, why are you going to take money out of the IRA? So those are some thoughts. I think over the long haul, I would look at good paying dividend stocks as the final answer, because you want to look at income, not just today, but over 3, 5, 10 years, and you're most likely to have increase of income over time with that type of portfolio, which is going to help you offset the inevitable inflation. Rick, where's the Dow going to be at the end of the year? Well, it's interesting because we didn't talk about it last year. The parade was led by utilities. Everyone dumped utilities thinking interest rates were going to go up, and utilities are a bit of a bond surrogate in the equity world, and utilities were up 24. Healthcare deemed safer, less cyclical, that was up about 20. So certainly utilities would not be something we're looking for, because we do think the interest rates are going to go up. At the bottom of the brigade was energy and telecom. I have to believe that both of those areas over the next 5 years will do better. That's why I gave you the Exxon and Chevron. So we would favor low leveraged, franchise, energy stocks with decent dividends. We think on a risk return, maybe not just this year, but over the next 3 to 5 years, that could do well. And it's worth looking at some of the telephone companies did not have a good year, but both. We live with our Verizon service, right, for our smartphones and so forth. That has a dividend of about 5%. That's something to look at, too, the telecom sector. I still think a lot of legacy technology companies, the Intels, the Microsofts, indeed the IBMs and Ciscos, offer a good combination of income, growth of that income, and they kind of control their markets. I would love to shift from one type of computer to another, but you know how difficult that is. Our mayor, former equity analyst. I don't have to worry about taxes or Social Security because I married a tax attorney who's an expert in both. So she really handles these questions. But I think the consensus is in our office is the longer you can defer, the better off you are. I mean, and I guess people say, well, if I die early, I won't benefit from waiting and from the higher rates. But if you die early, it doesn't really matter anyway. So that when you look at the increase in your Social Security payouts from waiting, you're hard pressed to do that with the government guarantee that you have with Social Security payments in the market. So we think that defer as long as possible, take the maximum payout that way. Well, there are many people in this room who are far more knowledgeable than I am on housing prices locally. I think that I would be optimistic and upbeat, and I'll tell you why. Although interest rates are poised to rise, we're starting from such a low level. We can all remember times when you'd have to pay, 7, 8, or more % for a mortgage. We're not going to see that in the foreseeable future. So that's a positive, I think, for real estate, lower interest rates. The second, of course, is I think the economy is recovering, and as people feel better about their jobs, as the unemployment rate comes down, I think people are going to be more inclined to move out of apartments, buy homes, or trade up for a better home, and that's going to boost demand. And of course, we all know about New Jersey, there's not much more room to grow, so we pretty much have a fixed supply. So I think overall, I would be optimistic on home prices in this area. Well, thank you so much.